Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's go to some of the stories we're following for you in the BNN Bloomberg newsroom. Construction has officially begun on an expansion at the Port of Montreal. The port was chosen as a nation-building project to be fast-tracked in order to strengthen and diversify the economy. Speaking at the port, Prime Minister Mark Carney said the project is the largest port expansion in Canadian history, and Ottawa will provide nearly $1.2 billion in financing. Carney says the port will generate more than $750 million every year for the Canadian economy.
This container terminal expansion will transform the Port of Montreal. It will add modern, high-efficiency terminals, and integrated fully with rail, road, marine infrastructure, increasing capacity at the port by 60%. It will open the door to new markets and a host of new trading opportunities for Canadian businesses.
The Royal Bank of Canada is launching a growth fund that will see it invest in Canadian businesses. The fund will invest as much as $1 billion over the coming years with the aim of helping companies build and scale in the country. CEO Dave McKay says the initiative is a key moment to turn Canada's economic prospects and investments around, combating a trend of entrepreneurs leaving the country to access foreign capital. Shares of BlackBerry are seeing a surge today after the technology company posted fourth quarter profit in sales that came in above Bay Street estimates, sales jumping 10% compared to the year before. Coming off these results, BlackBerry decided it's going to raise its revenue outlook for the first quarter. It has issued a full-year sales forecast that beats expectations. The CEO says the company's current position strengthens it against generic AI products. And a quick look at the markets. You can see the TSX, after that rally we've seen over the last few days, struggling today, off by about 0.2%. South of the border, there's been a turnaround from the start of the day. Earlier, they were off, noticeably some down about half point at one point, then slowly kind of turned it around. And now you can see they're surging ahead. The S&P 500 up by 0.6, Dow by 0.7, and the NASDAQ by 0.67. While the TSX continues to outperform its global peers, but once again, the leadership is coming from a narrow slice of the market with energy back in the driver's seat. We're joined now by Jack Manley, global market strategist at JP Morgan Asset Management. Jack, thanks very much for joining us.
Certainly. Well, thank you so much for having me.
All right. If you have all energy stocks, you're happy today, but is it a good thing overall that we're seeing that?
Yeah, I mean, just like if you had all gold stocks last year, you were thrilled. It's a very similar story in 2026. Yeah, when I think about investing in high-quality developed markets, and Canada would certainly be included in that basket, one of the problems I see for long-term investors is that these markets are, at the end of the day, highly cyclical. You know, Canada in particular is going to be levered to energy, to materials. You have other high-quality developed markets that are more levered to industrials, to financials. But either way you look at it, the way that these markets typically perform is that they can have good years, they can have bad years, they can have years where they handily outperform the U.S., in fact, and we saw that last year. But over the long run, it is very, very difficult to make an argument that secular will underperform cyclical, that growth will underperform value. And for that reason, I wouldn't get too excited or read too much into the outperformance we've seen from the TSX relative to the S&P so far this year, or certainly even over the course of 2025.
And what are the good things about it? What are the concerns about it, where we're standing?
Well, I think in general, we've had some good news out of Iran, the first good news that we've gotten in a long time. And so markets have been relatively happy about that, right? And it's a combined factor of, I suppose, lower oil prices, so lower input prices. It eases a little bit of the concerns around inflation or downward pressure on margins. And of course, a pop in sentiment. But interestingly enough, Roger, I think if you look at what's going on in today's market, you are reminded of the fact that even before this conflict kicked off at the end of February, global markets and the U.S. market in particular were going through a lot of different headline-associated shocks. You had regime change in Venezuela. You had a rout in Japanese government bonds. You had a seeming implosion in private credit markets, that high-profile Citrini report that came out, a collapse in software stocks. This was a market that was dogged by negative headlines really from the get-go. And while we do have some good news, probably the most important piece of good news that we could have expected, at least given what's going on right now at this very moment, it does not signal the fact that the coast is entirely clear. There is still a lot to be digested, still a lot of existential questions almost that this market has to grapple with in the next coming months.
And there is oil, of course, the big, and we're seeing. We're here that the truce is holding, but we're still hearing some shots fired here and there. Now we're hearing Israel is ready. It's being asked to talk. Lebanon asked to talk with Israel. These are all positives. What will this mean for oil? Will we see it drop? We saw it surge again today, or not surge compared to what we saw yesterday, but upward today. So what? Where do you think this leaves oil? Where is it heading?
I think it is important to remember right off the bat that while we're all rooting for this ceasefire, undoubtedly, it is definitionally temporary. It is 2 weeks long to give these two sides time to come together and negotiate. And from where we stand right now, what we're seeing at the global stage, there are big differences in positions between the United States and Israel and Iran. It means that we're not going to see a true end to this conflict tomorrow or perhaps even next week. It's going to take more time to negotiate into some sort of steady state where all sides are at least reasonably happy. What that means is that we're probably going to see more days like today, coupled with days like yesterday, right? Big shocks higher, big shocks lower, oil ultimately settling at a level that is lower than its peak, which had been achieved just earlier this week, but certainly a whole lot higher than where we were in the days leading up to this conflict, right? A cost of a barrel of WTI crude was south of $60. We're not getting back to that level anytime soon. There will always be, or at least in a semi-permanent sense, always be a higher risk premium associated with global crude because of Iran's effective control over the Strait of Hormuz, its ability to project power in that region. And so crude prices will, I think, be structurally higher than they were for most of the first quarter of this year.
So, that raises concerns about inflation and then the Fed and the Bank of Canada. How does that all play in?
There's no way to sugarcoat this story, Roger, and say that higher energy costs aren't inflationary. They are. But what matters a whole lot when you're talking about higher energy costs and the relationship to inflation is the fact that both of these countries, both the United States and Canada, are a whole lot less energy intensive than they used to be. They are both net energy exporters and therefore fully energy independent, which means they are more insulated from energy shocks today than they would have been even 20 years ago. Forget about back in the 1970s during the oil embargo. We're also looking at countries that were experiencing relatively low levels of inflation going into this situation, right? When we were tempted to compare this to what happened back in 2022 when Russia invaded Ukraine and inflation in Canada reached over 8%, inflation in the United States over 9%, the baseline level of inflation at that time was already elevated. Right, even without energy inflation in 2022, CPI in the United States would have been north of 6%. Today, the most recent read that we have back pocket is south of 2.5%. So we might see incremental inflation. In fact, we almost certainly will see incremental inflation. Numbers that start with 2s now may start with 3s or 4s in the coming weeks, but we are not returning to where we were back in 2022. It would take a lot more than where we are right now to get to that level. And B, I don't think either the central banks or either central bank in either of our countries, right, the Bank of Canada or the Federal Reserve, is going to meaningfully change policy because of this temporary supply shock. So my view, inflation drifts up a little bit over the next few months, drifts lower through the end of the year. The Bank of Canada remains on hold, as it was telegraphing at the beginning of the year. The Federal Reserve commits to one more cut at some point in the back half, perhaps the back quarter.
All right, we have to wrap it up there, Jack, but thanks as always for joining us.
Great to be here. Thank you.
Jack Manley is Global Market Strategist at JP Morgan Asset Management. Coming up, how to invest as markets continue to be extremely volatile, the uncertainty, that fragile ceasefire in Iran. We'll find out more after this. Oil prices are rallying in and markets continue to stay volatile. Can the increased volatility offer investment opportunities? Earlier, we spoke with Nick Picard, Chief Options Strategist and Portfolio Manager at Hamilton ETFs.
A couple months ago, people had forgotten the importance of energy in your portfolio, and we're seeing now that it can be very, very important. And all this volatility that we're seeing because of what's happening in the Middle East has driven the VIX from below 20 in the teens to at one point over 30. But even today, it remains relatively high. And this is a good time to be looking at doing a covered call strategy, maybe even on your energy stocks that have benefited from this environment.
So talk to us about that. So say you are long a bunch of energy stocks. The classic covered call strategy would be to sell call options on them to investors who think they're going even higher.
Yeah, well, look, so for example, take an example like Suncor, which has benefited, Canadian oil producers benefited from the current high crude oil environment. Mm-hmm. As of last night, you could have taken, sold a 1 month call option, which gives you some premium, some income for your portfolio. So you limit some of the upside that you get from your stock, but for a 1 month call option on Suncor today, you could get close to $3 on a $89 stock. So that is, that's almost 3% per month that you could be getting by selling those call options. And what happens when you're doing a covered call strategy is you're able to monetize some of that volatility and get income in your portfolio. This is what we do in our energy covered call ETF called EMAX. We take a lot of these oil and gas names, mm-hmm. and we write options on them. And what's been great is that with these higher prices, we're getting more premium.
Right. So that's EMAX, and it's an energy player, but it maximizes yield to investors. That's the philosophy.
Exactly. That's the philosophy. And what's great about this environment is normally what you see in the market is the volatility tends to go higher when the markets go down because things are more uncertain. What's been great about the energy is that things have been more volatile, but they've been moving up. So you're kind of getting a win-win situation in the sense that you're getting higher energy prices, but you're also getting more volatility. So you're getting more premium for your options, and you're getting those higher prices.
Right. And so we're looking at over the past year, excuse me, I think we just showed a chart, and this one is up something like 40% in the past year. Although if you look at the TSX Energy Index, it's up 66% in the past year. And the total...
Yeah, and so that...
I'm sorry to interrupt. The total return from EMAX has been about 59%, whereas I would have, if I just invested in the energy index, I would have made a total return of 73%.
Yeah, and so that's one of the things that you have to be conscious of when you're using a covered call strategy is that you're giving up some of that upside in return for the income that you're receiving, from the options, from the portfolio. Mm-hmm. So this is definitely geared towards investors who are looking for income.
Right, yeah, and it's kind of apples and oranges in that way. In the current environment, what about banks? Is there a case to be made for loading up on them?
Yeah, well, of course, one of the things that you have to worry about in the environment that we're in right now, a more volatile environment for investors who are worried about the risk in the market. You want to make sure that you gravitate towards quality and lower volatility stocks. And the Canadian banks certainly fit that bill. We like to look at stocks that have been growing their dividend for many, many years. We have a strategy that just focuses on that, focusing on stocks that have grown their dividend for years and years and years, just, no matter what market cycle you find yourself in. And we call them the dividend champions. And if you look at companies like Enbridge or Royal Bank, they've grown their dividend for over, they've grown their dividends for over 25 years. So when your markets get more volatile, you want to focus on quality.
Again, I guess I should point out, so you have CMVP, Canadian Dividend Champions, and you've explained the philosophy there.
Yeah.
Total return in the past year of 42%, and that has matched the utilities index, although it has lagged, it's slightly beaten it, although it has lagged the bank index. That has given you a return of almost 68% in the past year.
Yeah, it's a diversified portfolio. So you're going to have some banks in there. You're going to have some, some pipelines. You're going to have some consumer staples. But it's outperformed the TSX 60, and that's really what we're hoping to do, to outperform the broad benchmarks with a diversified portfolio and with lower volatility to the investor.
Yeah, it is interesting. That's a popular model. People love that regular distribution. Can you just remind us, is there ever a return of capital involved? Well,
for our yield maximizer ETFs, the ones that do the cover calls, because some of the options, we don't capture all of the upside, in the stock. Like Suncor has been going up for the last month and a half. For options that we sold a month ago, we're not going to have a gain on that. And so some of the distributions that we pay out are going to be return on capital. Some are going to be capital gains because option premiums are considered capital gains. But overall, it's actually fairly tax efficient for the investor.
That was Nick Picard, Chief Options Strategist and Portfolio Manager at Hamilton ETFs. Canada may have more leverage with Washington than it thinks as the war in Iran strains U.S. alliances and trade ties. We'll explain after the break. As U.S. President Donald Trump lashes out at NATO allies over the closure of the Strait of Hormuz, Canada's economic ties with the U.S. are coming into sharper focus with a high-stakes CUSMA review ahead. Questions are growing over whether Ottawa could use energy, resources, and diplomatic support to gain ground with the White House. For more on this story, let's bring in Bloomberg's Derek DeClue. Derek, thanks as always for joining us. I think we've kind of looked at this as the elephant in the mouse. I mean, that's the classic U.S.-Canadian image, but we actually maybe not the mouse this time.
Well, if you look at what's going on in Iran and in the Middle East more broadly, amid this conflict, what are the problems that have resulted from a business and economic point of view? Obviously, higher fuel prices, choking off of oil supply, LNG, but also other things like fertilizer and aluminum that are maybe less well known in the supply chain that comes out of the Middle East, but are also important. Well, what does Canada have an abundance of? Oil and gas, fertilizer, potash, and of course we're a major aluminum producer and a large foreign supplier of that very important metal to the U.S., or at least that was the case before Trump put on the tariffs. So the theory here that's kind of percolating, and a number of people have expressed it. We've talked to international trade lawyers. Some experts have been writing publicly about it. Is that Canada, as a reliable supplier of these goods, perhaps has a bit of a bargaining position, and certainly may be seen slightly more favorably. I think that's part of the reason why, by the Trump administration, and I think that's part of the reason why the government was very quick when this conflict started to go out there and say, of course we will contribute more to the oil supply. We will look for ways to put more barrels on global markets. We don't have a ton of ability to put a lot more barrels on crude markets globally, like just sort of at the drop of a hat. But the noises were coming from Ottawa on that subject were quite deliberate.
And that kind of stretches in also to the minerals, the critical minerals that the U.S. needs. Do the Americans think we can actually get them out of the ground? Do we have the capabilities? I mean, you talk about the Ring of Fire in Northern Ontario, and we've been talking about it for 2.5 decades.
Right. I mean, this is not just a question for the Americans. It's a pretty key question for policymakers. We hear lots of announcements about it, not only from the Prime Minister, but from the Ontario Premier and other leaders. And I think the critical minerals game is a long game, and certainly for Canada to have better leverage in trade negotiations going forward in future years, whatever they may be, but certainly in the relationship with the United States, it's going to have to prove that it can be that reliable supplier and not just a country that talks about critical minerals. And that's also not just about what we have in the ground, but also about the ability to process these things, because that has proved to be China's big advantage is the ability to process critical minerals into products that are more useful at the industrial level.
And of course, Canada has flirted with China as we're getting ready to do these negotiations. We've stood by the Americans on some things, and then we've said with the straight, no, we don't want to see this happen. All that, going into the CUSMA review, what kind of an impact is everything going to have? How is it going to affect that, do you think?
I think there's a really interesting point there, and that is that we have been pulling a little bit closer to China. I wouldn't say close to China, and with other potential trading partners. There's the talk of the trade deal with India. But one of the things the Americans are going to probably want going forward and in this review and in the future trade relationship is some kind of common policy across the continent on tariffs on certain key products, like seeking Canada to match U.S. tariffs, for example, on whatever it may be, steel. Back in the day when Trudeau was prime minister, we matched the U.S. on Chinese electric vehicle tariffs and so on. The Americans like that when Canada sort of matches, but now we are taking trade policy into a bit of a different realm where we're going to have perhaps a different relationship with China and a different relationship with India and so on. That's a fundamental tension that exists that really has, we have yet to see how that can be resolved in the USMCA review, but it's likely to come up.
All right, we have to wrap it up there, Derek, but thanks as always for talking to us.
Thank you.
Derek DeClute is from Bloomberg News. When we come back, Canadians seem to be excited about AI, but businesses aren't adopting it nearly as fast as we'd expect. We'll break down what's behind the gap after this. The U.S. economy grew at 0.5% annual pace in the fourth quarter, missing the expected gain of 0.7%. Consumer spending expanded at nearly 2%, helping to lift GDP for the period. However, the increase was offset by declines in government spending and exports. For all of 2025, the economy grew 2.1%, the slowest since 2023. Shares of G Mining Ventures are seeing some pressure today, down about 3.7%. The company is set to buy G2 Goldfields in a deal valued at roughly $3 billion. The company calls the transaction a uniquely synergistic acquisition that will create a Tier 1 gold mining hub in Guyana. Executives say the combined projects in the region will deliver significant results, adding that shared infrastructure will lower operating costs and increase production. Canadian retailer Roots swung to a profit in its latest quarter as sales and profit topped expectations. Revenue rose by more than 5%. Margins improved as well. The clothing retailer launched a strategic review last month that could include the sale of the company. CEO Megan Roach says the company is pleased with the level of interest and engagement in the process. Taking a look at the markets, the TSX still in the red today after the huge rally yesterday across the board. Today, though, it's down by 0.35%. South of the border, different story. After starting off in the red, they are firmly on the positive side. S&P 500 by almost 0.6%, down nearly by 0.7%, and the NASDAQ by 0.67% right now. Well, Canadians have bought into the AI hype. In fact, we're some of the most frequent users of generative AI tools in the world. But when it comes to adopting it at the enterprise level, many Canadian businesses are lagging. So what's driving this gap between interest and impact? Joining me now is Rosalie Wanch, Associate Director of Research at the CD Howe Institute. Rosalie, thanks very much for joining me today.
Oh, I'm happy to be here.
Okay, AI. Everybody's talking about it. We're watching how much money is spent on it, and yet Canadian companies aren't using it.
No, it's actually, we see in the data that about 12% of companies were using AI last year, but only about 2.3% more companies plan to use it this year. So that we have a clear sign that adoption is slowing. But Canadians themselves are actually using the dominant LLM platforms at higher rates than most other countries. So there is this interesting gap.
It must be maybe Canadians because we're shy to talk to other people, but we're okay talking to machines, and that's making us happy. What's stopping business from doing this? Why is it ignorance? Is it fear? Is it government red tape?
Well, for most businesses, the vast majority of businesses, they respond that they don't have plans to adopt AI because they don't see AI as relevant to their business operations or the products or services they produce. However, the industries where AI is more relevant and we do see higher adoption, the largest barriers tend to be a lack of human capital, as in they may not have the staff that has knowledge of how to implement the AI or exactly how to use it. And we don't see actually that cost or regulation is a common barrier. Normally it's knowledge, uncertainty, or a lack of human capital that is holding people back.
There is a bit of a disconnect. Because Toronto, Waterloo, this area here, it's one of the AI centers in the world, is it not? Yet we're not seeming to see it expand out beyond the research institutes.
Well, actually, when we look at the international comparisons, Canada is still very much a strong performer on research. We produce more research on AI per capita than almost any of the comparator countries. But it's almost a perennial Canadian challenge where we're really strong on research, but then we seem to be lagging a little bit on infrastructure development and the commercialization side of AI, where the US is really standing out as a clear leader.
Now, would government intervention help, or government pullback? What's needed here?
Well, I think that there's a combination of strategies that are needed because on the one hand, Canada does need to make sure it has the infrastructure to support a strong AI development market and support that broader business adoption. So there is a need to invest in infrastructure and to encourage private industry to build out that infrastructure and compute capacity. But then separately, there is a need to look at adoption and the policies there, because that's really truly where the long-term economic growth will come from. But since we have a large number of businesses saying that they don't have the human capital or there's the knowledge about AI to know how or why it could be relevant to their business, there is certainly an educational side of this as well, and potentially the need for tax credits or some demand side business-oriented policies to encourage businesses to start experimenting and trying AI so that they can then maybe overcome some of those barriers. And hopefully we can get broad diffusion, because that's really where the rubber hits the road. Using AI for chatbots and to talk to is one thing, but where the real growth and productivity will come from is when businesses reorient their supply chains, their business models, their processes around AI, and we really reimagine how we can do things. And we can't do that until we've actually, integrated it, played around with it, tried to integrate it into existing processes before we can really understand how you could reimagine things around this new tool.
Now, is there a real danger that the corporate businesses could lag behind and fall behind the rest of the world, but also we could lose that edge when it comes to research because we'll see people moving elsewhere where they see more opportunities?
I think that is a risk. Canada still ranks highly across the international rankings. The research that we did looked at 5 different rankings, and overall, Canada ranks about 8th. But the concerning factor is that our relative position has been declining over time. And so our global position is eroding as a leader, where a few years ago, Canada was much more clearly in the top 10, and these days it's less certain. So their time is of the essence, and we are, in fact, seeing early signs of falling behind. But we aren't, yet behind. We are still a world leader. So if we move quickly, we won't lose that competitive advantage.
All right. And tell us more about TechStat and what that might help.
Yes, absolutely. So part of the challenge I faced when doing this research was that we actually have very little data and information about what businesses are doing with AI. We only have about 2 data points each for are they using it and are they planning to use it, let alone what for, and how it's working, how it's impacting their productivity. And that one survey is actually set to end. Thankfully, the federal government had already budgeted money last year to expand our AI data and observation at Statistics Canada. And so I think that also needs to be done, because the more we know about how businesses are using it, what barriers they face, and where it's successful, the more we can have evidence-based and targeted policies that really drive towards that productivity. But you can't have evidence-based policy if you don't have that evidence. So I would say time is of the essence. We need a little bit more information to say anything with much certainty these days.
Okay, we have to wrap it up there, Rosalie, but thank you very much for joining us.
Thanks. Happy to chat about AI anytime.
All right, we'll talk more about it, I'm sure, in the future. Rosalie Watch is Associate Director of Research at the C.D. Howe Institute. Coming up, with geopolitical fears easing, our next guest says it's an opportunity for tech. We'll find out more after the break. Markets may be leaning risk on today after signs of a ceasefire between the U.S. and Iran, with volatility pulling big tech and software stocks lower in recent months. Our next guest says the sell-off has gone too far. Here to discuss that is Dan Ives, Managing Director and Senior Equity Research Analyst covering the tech sector at Wedbush Security. Dan, thanks very much for joining us.
Great to be here.
Okay, what makes you think they've gone too far?
I mean, I think, look, if you look at the backdrop right now in terms of the Iran worries, what we've seen in terms of just some of the big tech concerns, in terms of, I think, Anthropic, what that's done to the software trade, too big to fail. The reality is we're in year 3 of an 8 to 10 year build out of the AI revolution. And I believe tech stocks will see new all-time highs as we go in by the summer. And I think you're seeing tech way oversold here. And now with the black swan sort of Iran situation, that now contained, I think you see a risk on in this market for the coming weeks.
Now, there had been talk about money moving from the Mag 7 and the AI build-out and into the companies that are incorporating AI. Do you think we'll see that still, or do you think it's going to go back to like the Mag 7?
No, look, I think this trade had spread out. I mean, I just continued. We have the Ives AI 30 in terms of the derivatives across software, across cybersecurity, across infrastructure. You can't just play Mag 7. You have to play these other on software and chips and, and infrastructure. But I do think, look, I think Mag 7 is massively oversold relative to what I think Microsoft is one of the most disconnected sell-offs I've seen in the last 20 years. Apple is about to actually ultimately have the consumer AI revolution with Siri AI. That's not reflecting that. Tesla is another example. So I think Mag 7 is probably going to be up about 30% from these levels over the next year.
Wow. Okay. So with Microsoft, why do you see people? Why did they panic so much, and what gives you the confidence that it's going to rise?
Look, I think the panic is that when you think about Anthropic, OpenAI, the worry is that that's ultimately going to, they didn't really unseat Microsoft a bit in terms of their ability to ramp on hyperscaler, in terms of pricing. I also think Google's narrowed the gap. And I think that combined with Copilot that's been very subpar, worries that even though they were first to market, that they're not going to be able to monetize the sort of golden goose here. And I think that's wrong. All of our checks are showing us the opposite. And I think this is a stock right now trading, call it a 8-10 year. You'd have to go back to low multiple that we've seen in name. And my view is the AI revolution will not be successful without Microsoft, just given how embedded they are in enterprises.
And with Apple, I mean, they had their great rollout with their newest phone, but it's almost been quiet in the AI sector, hasn't it? It hasn't been talked about.
quiet would almost be a compliment. I mean, look, that they've missed the first 2 years of the AI revolution. A lot of that was self-inflicted. They were not going to be able to develop it internally. But finally now, with Google Gemini, with Siri AI, they're going to roll out what I ultimately view is going to be a subscription service. I mean, most consumers in the world will access AI through an Apple device. And I think it all starts, over the coming months as they roll it out. And that's going to be a boom in terms of services, in terms of developers. I think ultimately you're going to have AI app stores deployed. And that will be the consumer AI revolution will be through Apple. And I think that's worth $75 to $100 per share.
All right. And you've been talking with CIOs about 2026. I think a lot of people agree this is the year. We have to see AI come into effect. What are you hearing from them?
I think you start to see it in 1Q earnings season. The deployments are starting outside Palantir. No one's seen on software. That's going to change as we go into 1Q. I think this is going to start to be the monetization of AI. Well, clearly, a lot of frustration because of the CapEx buildup, but you haven't seen monetization from Meta to Microsoft to Salesforce and a lot of the software companies. I think that all starts to change. We now are starting to go into the use case monetization theme. And that's why I think software continues to be the most oversold subsector of tech.
I mean, these companies, I think a lot of people are dismissing them. I mean, these companies, they know how to use new tools that come in. And essentially, is AI to them a new tool?
Well, and also it's not just like to that point. It's also like in Anthropic and OpenAI, they're going to need software companies in terms of partnerships. They're not going to be able to do AI native stack alone. No, these models like Claude, they're phenomenal. But the reality is that the winners are going to lie in who has the data, who has the data stack, and who has the install base. And that's why I think right now a lot of that is being way overly discounted in terms of what I almost calls an AI ghost trade that's been the black cloud over software.
All right, I want to sneak in. We're almost out of time, but AI and cybersecurity, I know a lot of people are afraid, I think, of what AI could do to cybersecurity, but you see a positive to it as well.
But that being afraid, that's money for when it comes to CrowdStrike, Palo Alto. I think this is going to be a boom for cybersecurity. Those are the two top picks. Zscaler is another name that I think is going to benefit. And I think cybersecurity budgets double next 2-3 years. And that's why those are the golden names you want to own, despite, again, those stocks have been down because of worries about the Anthropic ghost trade.
All right, Dan, we have to wrap it up there, but thanks very much for joining us.
Thank you.
Dan Ives is Managing Director and Senior Equity Research Analyst covering the tech sector at Wedbush Securities. Still ahead, today's Market Movers with Bloomberg's Matthew Griffin. Time to take a look at some movers south of the border, and we are joined by Bloomberg Equities reporter Matthew Griffin. Matthew, thank you as always for joining us, sir.
Roger, thank you as always for having me.
All right, Tesla, everybody loves it, everybody hates it, and it's ending a streak.
Yes, so Tesla now up about 1.5% today and snapping what had been a 4-day losing streak. Also, I was just watching the chart, trying to break out of this, what's seen as a bearish technical pattern that had drawn some scrutiny on the stock in recent days. It's something called a death cross, so pretty intimidating name there. It's basically when the longer term average of the stock's price closes below the shorter term, so the 200-day and the 50-day moving average of the stock. Of course, that's getting technical, but what it really shows is that the stock is in a pronounced downtrend, that the longer term trend for that stock looks more negative even than the shorter term trend. And I think I was backwards there. You got the 50-day moving average falling below the 200-day there. And now today, trying to break back above, just on the line there. Some technical market analysts see that if you're in that death cross pattern as a sign of more declines. And so it would potentially be a good sign for the stock if we broke out. Of course, never a guarantee there that those predictions pan out, but basically you have this stock hovering between a really, a pronounced downtrend and a bit of a rebound today. And, coming a week after the stock, again, the company missed expectations for its EV sales. I think it's one that there's really a heightened focus on Wall Street right now.
Of course, with every, just being us up in space, Artemis up in space right now. I think that's drawn attention to Elon Musk, to SpaceX, to Tesla. And it's Elon Musk. People are always looking for something from him, aren't they?
Yes, they absolutely are. And, it's going to be interesting to see how SpaceX trades when it goes public. They're reportedly targeting later this year, maybe in the summer. Is SpaceX going to command the kind of sky high valuation multiples that Tesla does? Is it going to trade really strongly on the fundamentals or kind of with sentiment in the way Tesla does? It could be another really interesting stock to watch.
Oh, yeah. And that's for the summer. Okay. For now, though, we have Palantir. It dropped like a bit of a stone, lowest since February 5th.
Yes, and now down about 25% year to date. And I know you were just talking about this tech sell-off. I think it's worth looking at some of these names like Palantir, which I think are examples of how indiscriminate the selling can get in the software space right now. You have Palantir, which is a company that has AI offerings that was seen as an AI winner for so long. Now, like you said, dropping like a stone alongside software companies that are seen as maybe more traditional, like an Intuit, tax software, Workday in HR. So, really you have this pattern of investors just clicking sell across the software part of their portfolio whenever anything that they see as negative happens. And, the catalysts can be anything too. Earlier this year, it was Anthropic's legal software tools. Now you've got this Anthropic agent tool they rolled out earlier this week. You've got a new AI model from Meta, and all of these catalysts, whatever they are, seem to be setting off selling in software stocks, whatever they are.
Okay, let's get in one more. Chevron, they're coming up short on production, but they're doing all right with oil prices.
Yes, and the stock has been swinging today correspondingly, now down about 1.5%, even as oil, Brent crude is lightly in the green. You had a bit of a mixed bag of an update. So, you were asking me earlier this week if we'd see more of the negatives from energy companies related to the war in Iran. You're getting some of that from them. Lost about 6% of their global production in the first quarter due to the war, the disruptions in the Middle East. They also saw $2.7 to $3.7 billion of a hit to earnings from what they call timing effects. A lot of that is these commodity hedges that hit Phillips 66 as well that we were talking about. Of course, there are positives. You have the price of energy rallying. And so RBC weighed in today. They said, you've got some short-term volatility here, but in the long run, you're going to see this flow through and be a positive to the company on a net basis, at least.
Okay, we'll wrap it up there, Matthew, but always a pleasure talking with you, sir. Have a good afternoon. And that was Bloomberg's Matthew Griffin. Let's take a quick look at the markets on Bay and Wall Streets before we wrap up for the hour. And first up, we'll take a look at the U.S. markets. And everybody solid into the green again after that big rally yesterday. S&P 500 up 0.67%, Dow Jones 0.8%. Even the NASDAQ with that software sell-off is still up by 0.77. The TSX, it's kind of finding itself today. It was down earlier, and now it's slowly clawing its way back up, but still off by about 0.2%. One stock of note, BlackBerry. It is on a nice little roll right now, up 6.75% on its latest numbers, and the confidence moving forward with it. And that wraps up this edition of Trading Day. I'm Roger Peterson. Thank you very much for joining us.